As I mentioned earlier, regarding that there could be some tax benefits from doing covered calls, let's do a little recap on stock options. Options can only be bought and sold in groups or bundles of 100 called a contract. One option contract equals or represents 100 shares of stock. So to sell a covered call option contract, you must have at least 100 shares of stock. Now let's continue. Say the current price of a stock XYZ is $50 per share. Suppose you buy 100 shares of stock for $50 a share. That's $5,000. Now let's say it's June 16th. You then sell an out-of-the-money option on the stock XYZ that you just purchased. The July 5250 call strike for $1.50 a share. That's a 3% profit based on the original purchase price of $50 of the underlying stock. Because the option has only a limited lifespan, you can keep on doing this every 4 to 6 weeks. 3%. That's per trade. Now that may not sound like a lot, but if you repeat it with new contract months every 4 to 6 weeks, by the end of the year, in this example, based on every 4 weeks, that's almost 36% pure profit, simple interest, not compound interest. And based on every 6 weeks, it's still almost 24% simple interest, not compound interest. To gain a better understanding of how powerful these rates of return are, I'm going to introduce you to the Rule of 72. It was developed by one of the greatest scientists of all times, Albert Einstein. The story goes that after being audited by the IRS, he started to think about interest rates, specifically the magic of compound interest. Surprisingly, it's very simple to apply, and here it is. For example, there's some of you listening to this who are paying 10% on their credit cards, and in some cases as high as 18 or 21%. But for example purposes, let's stick with 12% annual rate on your credit card. Say you owed $1,000 and we're paying 12% on the $1,000 to your credit card company. If you did not make any payments to that bill, the outstanding balance, that is the $1,000, would turn into $2,000 of debt in 6 years. What you would do is divide 72 by the interest rate. In this case, it's 12%. 72 divided by 12, which is the interest rate, is 6. Or in this case, 6 years. And for those of you paying 18% annual interest, divide 72 by 18 and your debt doubles every 4 years. I'm not here to talk about debt. I'm here to talk about making money, getting incredible rates of return. Yes, you can make money. Let's continue. Remember, you sold one contract, which is covered by the 100 shares of stock you just purchased. That's 100 times $1.50 a share, which equals $150. The sale of the option contract triggered a capital gain, taxes. There is a way you can legally not pay taxes, or at least delay paying your taxes. The tax code allows you to make an adjusted cost basis on the stock you purchased. The purchasing of the stock, which cost you $50 a share, allowed you to sell the option and take in money, $1.50 a share, or $150 per contract, which can be applied to the cost basis of the underlying stock. So your new cost basis of the stock is now $48.50 a share, or $4,850 for 100 shares of stock, as opposed to the $5,000 that you initially spent to buy the stock. And no capital gains. In theory, you could keep selling options against your stock till you have a cost basis of 0. However, once you sell the stock itself, a capital gain would be then triggered on the entire amount of the sale. So if your adjusted cost basis was 0, no matter what you sold the stock for, there would be capital gains on the amount. So even if you sold the stock at $45 a share, which is less than what you originally purchased the stock for, which was $50 a share, all $45 would be subject to capital gains because your adjusted cost basis was zero. Suppose your adjusted cost basis was something other than zero. Now let's say that the adjusted cost basis was $39 and you sold the stock for $45. Then there would be $6 subject to capital gains. That is the difference from the adjusted cost basis to where you actually sold the stock. Some of you out there may ask, well, what's the difference in paying the taxes now versus later? Well, that's simple. Taxes delayed is actually more money in your pocket. For example, suppose somebody owes you money. If the debt is allowed to continue for some time, inflation will eat up the real buying power of that money that was owed you. Well, the same thing works with money you owe in taxes to the government. The longer you can delay in paying those taxes, is the less in real terms, in real buying power that you will pay back to the government. Here's the best part of it. Though the taxes are delayed in their payment, there is no penalty or interest on those delayed taxes because the cost basis of the stock and capital gains isn't realized until you actually sell the stock. Now, before going out on your own and trying this tax strategy, please see a tax professional who is familiar with the tax code as it applies to the stock market.